Hall and Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello everyone, and welcome back to our final episode in our tax records series. For this episode, we're going back in time to look at an age-old topic in the world of tax, the capital revenue distinction. My name is Jacqueline McGrath, and I'm a partner in the tax team here at Hall and Wilcox. Today, I'm pleased to be joined by my colleague and fellow tax partner, Adam Demack. In our last episode, we discussed gifts of money to overseas relatives. Today, as I mentioned, we're chatting about the capital revenue distinction. More specifically, we're going to look at the distinction in the context of property development. So let's dive into some questions. To kick things off, Adam, as tax people, we know that capital revenue debate has been around for a very long time. Do you think that this is something that the Commissioner of Taxation is still focused on? And if you agree with that, why?
Yeah, look, in my opinion, it's no secret. I think that the Commissioner and the ATO have for many years had a focus on the capital revenue distinction in the real property and modern land development space. That's certainly what I've seen in my practice. But if you don't believe that and don't believe what I'm saying, it's probably also reflected in the fact that we have two published cases on point in 2025. We had a full federal court decision handed down on the Friday that has just passed, which we might talk about today. And on top of that, obviously, there are probably many other unreported disputes that are in objection phase or that parties have settled. So we're definitely seeing a lot of activity here, even in terms of what is available publicly. And if you're involved in this space, what you'll see is that the Commissioner's view seems to be that many of the seminal cases on this issue, so on the capital revenue issue, so cases like Casamati and Statham and Scottish Mining, the Commissioner seems to take the view that those cases are decades old. The developments that took place in those cases were decades ago, and they're probably not reflective of what you might describe as a modern land development. And the Commissioner has publicly taken that position. You can see that in a few of the recent case judgments. And so as for the why, I think the Commissioner is seeing a lot of property development activity taking place. He's obviously wanting to make sure that people are returning income correctly and taking up the correct positions, and perhaps seeing an opportunity here that maybe the seminal case law isn't necessarily going to be reflective of what is happening in a modern land development.
So you mentioned a few recent cases. Could you take us through an overview of each of them?
Yeah, sure. There are three cases probably to be spoken about. The most important and most relevant is a decision known as Morden. And I say that because the full federal court handed down its appeal judgment on Friday. And then the other two cases are VZFS and Nerang subdivisions. I'll speak about them as well. They're GST cases, though, whereas Morden is an income tax case. And Morden is probably the best example, not only because it was the most recent example and not only because it's an example that the taxpayer won, but it's probably most reflective of the type of development that you will see commonly happening. It involves the development of farming land that was farmed for many decades, and farming land that was ultimately developed following a rezoning that the taxpayer had nothing to do with. So this taxpayer, Morden, basically held a block of land that he got from his father in 1980. It was rezoned. He farmed it for decades, both before the rezoning and then for several years after the rezoning. But, the costs of land tax and other taxes that arose because of the rezoning and urban enroachment really made the farming activities unviable. And so Morden entered into a land development by signing an agreement with a developer, with a professional land developer. And his property was turned into 50 lots, 48 residential lots and 2 commercial lots. There was a dispute between Morden and the Commissioner. The Commissioner said, well, your proceeds from the sale of these lots are taxable on revenue account, either because the land became trading stock or because the land was ventured into a profit-making undertaking or scheme. Morden, on the other hand, said, well, no, if you look at the seminal cases, really what is happening here is the mere realisation of a capital asset. And ultimately, the federal court and on appeal, the full federal court agreed with Morden. And that case goes through the seminal cases and the development over the years of the principles from those seminal cases very well. So it's a great set of cases to read. Then we have the two other cases I mentioned, Nerang Subdivision and VZFS. They are both GST cases, and I think somewhat distinguishable from, most property development scenarios. So Nerang Subdivision is, I think, distinguishable, or the most distinguishable, first of all, because it wasn't a tax case. It was a case heard in the Supreme Court of Queensland between two commercial parties who were fighting over GST and ultimately who would bear the costs of GST. But probably more so than that, the subdivision in this case was expected to turn the land in question into several thousand lots that would net over $2 billion of revenue. So that is just an enormous subdivision relative to most of what I've seen in practice and most of what I've seen on the outskirts of Melbourne, Geelong and some of the other states. The case law, if you look at it, will tell you that the mere size of a subdivision or the mere magnitude of it will not necessarily convert it convert land from a capital asset to a revenue asset. But for GST purposes, we have a different threshold. The threshold really in these cases is whether a taxpayer is carrying on an enterprise. And that GST threshold of an enterprise has been compared to, and the case law tells us, is at least as broad as the concept of a profit-making undertaking or plan, which is an income tax concept. And I think it's probably logical to have the view that at some point, while mere magnitude might not be determinative to convert capital proceeds to revenue proceeds, it probably will have a major impact. And you saw that in Nerang subdivisions. The nature of the commercial arrangements was necessarily complex. The development was going to go on for many years. And so the involvement of the taxpayer or the landowner, you might say it was passive, but it at some point it stopped being passive and it became quite a involved process, which the Supreme Court said did amount to an enterprise. Then the last case to talk about here is VZFS. This was somewhere in the middle. This was a development, I believe, of about 750 lots, so still quite sizable. VZFS was also a GST case. And Senior Member Olding in that case gave a very good judgment comparing the decisions in Morden in first instance at the federal court and Nerang subdivision, and really getting to the heart of what matters in a GST case and when a taxpayer will be carrying on an enterprise, and also the relevance of the income tax cases to GST cases. And that case was decided in favour of the Commissioner. So the tribunal and Senior Member Olding did make a finding that the taxpayer was carrying on enterprise, which I think is an understandable finding based on the facts, and also noting that it was a development of about 750 lots, which is quite big.
So those cases all seem to concern the common situation where farming land, a capital asset, is later subject to some form of development. In the current economic climate and with the high level of property-based taxes, and particularly here in Victoria, are you seeing the opposite situation where land is slated for development but that development doesn't proceed?
Yeah, actually that is something that we have been seeing increasingly, and like you said, probably a reflection of maybe a slowing down and some other economic and financial matters impacting markets. You'd know, Jack, that there's the famous tax case, Whitford's Beach, where it's the first case that told us that a capital asset could be converted to a revenue asset if there was a change in intention. So, if the intention in respect of which the taxpayer was holding the land changed to a sufficient degree, then it would essentially be held on revenue account. In this scenario, it's a bit of what I like to sort of term the reverse Whitford's Beach, so the backwards version of that. And the example that we commonly see is a taxpayer has acquired an asset and they've slated that asset for development. So the plan is they're going to turn land into, say, 20 or 30 lots or maybe more, and they've prepared this detailed plan to do that subdivision. They've perhaps showed that plan to a banker or financier so that they can obtain money to carry out the development. And everything starts off great, but then for whatever reason, it all falls apart. And usually that reason is financial reasons. So the costs for building or development go up, or they can't obtain quite enough funding to carry out the development that they need. And then the question becomes, when they do sell the asset, well, how is that taxed? Clearly, if you look at the case law, if a taxpayer purchases an asset or acquires an asset intending to venture it into a profit-making undertaking or plan, which a subdivision is, then the proceeds from that would be taxable on revenue account. But that's not what is happening in these scenarios. And so you have a series of case law going back to at least 1970 that essentially tells you that if a taxpayer does acquire an asset as part of a profit-making undertaking or plan and has defined that plan with sufficient precision, but that plan is abandoned, then the proceeds will actually be realised on capital account, because the taxpayer's plan here was to carry out a development, but that is not the means by which they obtain a profit or proceeds. And so I won't give you the full case name, but there are some cases you can look at, Kratzmann, Roscoe and Steinberg. A few of those cases, actually, Kratzmann is a High Court case, as is Steinberg, and they essentially set out this outcome where a taxpayer has acquired an asset, clearly at the get-go as part of a profit-making undertaking or plan, but has to abandon that plan, still makes a profit from sale, but the courts tell us that profit and those proceeds are on capital account.
Do you have some suggestions for how taxpayers and advisors can manage the risk in this space?
Yeah, I can offer some opinions, but really I think many advisors will have their own views on what's best for a client, and that'll obviously depend on the client's circumstances. And as you know, sometimes clients won't want to do what you think is best for them anyway. Look, one thing, and I think you'll appreciate this, is that when you look at any sort of tax dispute or tax litigation, contemporaneous documentation becomes vital. Particularly when you're dealing with property development, being able to establish the intention for which you initially acquired property becomes vital, because unless you can establish and discharge your burden of proof that you acquired an asset on capital account, you're not getting off on the right foot. So contemporaneous documentation is vital. Often when it comes to land developments, what will be vital is what a third party was told in terms of why an asset was acquired. So, looking to what the banking documentation says, a bank will usually want to know why you're buying an asset, what you're going to do with it, and how you're planning to either derive a profit or perhaps not derive a profit from the land. So that's, I think that's pretty obvious to most advisors, that contemporaneous documentation and just having contemporaneous evidence to support a position is vital. But, sometimes as advisors, we're not there on the front end. We are asked to give advice after things have happened. And when you're looking at that situation, there are probably a few options. If you accept my view that the Commissioner and the ATO are focusing on this space, then I think unless your client has a set of very clear-cut circumstances, there's always going to be a degree of risk that the Commissioner will, take a look at how a return has been lodged and take a look at how proceeds from the sale of land have been returned. One option you can adopt to protect your client is to help them to develop a reasonably arguable position. As you know, that's something, if done properly, that can protect a client from the imposition of administrative penalties. But you have to develop a position that is as likely to be correct as not, and you have to look at the case law, and it becomes quite a detailed exercise. So that is something that you can help a client to put in place. That protects from penalties, but it does not give you certainty. Really, the only way to get certainty in terms of a position that a taxpayer will adopt will be to go to court or to get a PBR. And going to court, that is something that many people will not want to do, although it has become an increasingly popular option because of some issues around the PBR process, which I'll get to in a moment. But just to give you an example of what you might do, in one of the cases that I spoke about, VZFS, what the taxpayer actually did in that case was the taxpayer lodged or made lodgements on the basis that GST applied to the sale of lots, but then objected to their own lodgements. And that got the issue directly into objections and ultimately into the tribunal. So it was a way for that taxpayer to really sort of push the issue and to get the tribunal to make a decision. The other way to get certainty, if you don't want to do that, is via the PBR process. There are probably a few things that I want to point out here based on recent experience. If you know that the Commissioner is, I guess, focusing on this space, on this capital revenue distinction in property developments, and you know that he's taking a position that perhaps the seminal cases don't apply to modern land developments, unless your client has a very clear-cut set of circumstances, you're probably likely to get an unfavourable PBR, so a no. If you just take that for granted and think ahead around what the issues are in terms of disputing around a PBR, you probably have to tread cautiously. A dispute about a PBR is going to be limited to the PBR scheme as defined. So there's going to be no fact finding in a tribunal or in the federal court. And as you know, when you're an advisor, you prepare a PBR, you put in all of this work, but often the final PBR that you get is not the same as what you put forward. And I don't think there's any malice in this. I think the ATO officers are just looking to put the PBR into shape. They're looking to anonymise the PBR. But the point here is that what you put in when you lodge a PBR is not necessarily what you get out. And because a dispute about a PBR is limited to the PBR scheme, it becomes absolutely vital to make sure that that final PBR is accurate and nothing is omitted. And I think one of the best ways to do that is to just ask the ATO officer as the process is happening to see a draft of the PBR before it's finalised. The other point to make there is that if you object to a PBR, so if you get a PBR and it is an unfavourable PBR and you object to it, you are limited in your rights to object to the actual assessment. So the idea there is that you don't get two shots at a dispute. If you have a dispute with the Commissioner around whether the sale of an asset is on capital or revenue account in the PBR, and you lose that PBR and you lose your objection, you have to continue that dispute if you want to get what you might think is the right outcome. You can't just wait for the assessment to be issued and then object to the assessment, because otherwise you would really have two bites of the cherry. So I might leave it there in terms of discussing what the risk management options are, because I think that probably covers the board.
Thanks, Adam. And I guess just to close out, one other thing of note to mention is that the Commissioner has released a taxpayer alert to the property development industry, being Taxpayer Alert numbered 2026/1. This is a relatively recent publication in January or the end of January. Whilst not on capital revenue debate, it does speak to some increasing areas of concern for the ATO in this industry. Typical for taxpayer alerts, it does deploy a traffic light system for these areas of concern, and it delves into property development agreements and related party transactions, so that's worth a look as well. So my thanks to Adam, and thank you to everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or connect with us on LinkedIn. If you've enjoyed today's episode, please rate, review, or subscribe to our podcast wherever you get your podcasts. Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.